Welcome to The Explainer. Today, we're diving deep into ACHR Aviation. After a pretty dramatic drop, the charts are telling a really fascinating story, but it's full of twists and some seriously conflicting signals. So let's dig into the data and see what's really going on under the hood.
It all started right here, with this number. On its last trading day, ACHR Aviation took a nosedive, dropping almost 8% to close at $8.18. Now, a single-day drop that steep is a major red flag, and it immediately makes you stop and ask, whoa, what just happened?
But here's the thing. This wasn't just a quiet drift downward. No, this was a plunge on a huge spike in trading volume. And whenever you see a big price move backed by that much trading activity, it means big money is making some very decisive moves. It signals some serious conviction from the sellers, and that's a clue we just can't ignore.
All right, so let's put on our detective hats. Our investigation begins right now. We're going to follow the breadcrumbs the charts have left for us, decode all the technical indicators, and try to uncover the full story behind this sell-off to figure out what it could mean for ACHR's future.
So, after looking at the initial crime scene, what's our first take? After piecing together all the first clues, the conclusion is, well, pretty darn clear.
Yeah, at first glance, the evidence is just screaming one thing. Key indicators that measure the strength of a trend, like the Arun oscillator, are literally pegged at a rock-bottom -100. You don't get much more decisive than that. It's basically the chart shouting that the sellers are completely in the driver's seat right now.
Okay, so let's break down that evidence piece by piece. We're going to look at the raw power behind this move, starting with two key factors, momentum and volatility.
First up, our old friend the RSI, the Relative Strength Index. This little tool basically tells us if a stock has moved too far, too fast in one direction.
And look at that number, 2984. Now, for context, anything under 30 is what traders call oversold. So this is our first little clue that things might not be so simple. The downtrend is strong for sure, but this reading suggests the selling might have gotten a little carried away.
All right, next up is the MACD. We're looking at this to see if that downward push is still gaining steam or if it's starting to get a little tired.
And wow, the MACD is giving us a big, fat confirmation of that downtrend. I mean, look at this. The MACD line is below the signal line, the histogram's negative, all the pieces are pointing in the same direction. This isn't a whisper, it's a roar. The selling pressure is absolutely still on.
And if you thought that was bearish, check this out. The price has crashed right through all the key moving averages. We're talking short, medium, and long term. And breaking below that 200-day average in particular, that's a huge deal. For a lot of traders, that's the line in the sand between a long-term bull market and a bear market.
Okay, last piece of evidence in this section. Let's check out the volatility with Bollinger Bands. Think of these as a channel that shows the normal, expected range for the price.
And here's the kicker. The price didn't just fall to the bottom of the range, it blew right through it. When you see a stock trade outside its lower Bollinger Band, that's a sign of some pretty extreme selling pressure. It confirms this drop wasn't just a casual dip, it was a powerful, volatile shove downwards. But just when you think the case is closed, right? The verdict seems obvious, we get a twist. The volume indicators start telling a completely different and pretty fascinating story. There really is a twist in this tale. And this brings up a huge question. Are the big institutional investors, the so-called smart money, actually buying or selling here? Because, the data is giving us two totally conflicting answers depending on how you look at it. This right here sums up the whole mystery. On one hand, you have the on-balance volume. That's a long-term indicator, and it's positive. That suggests that over time, big money might be quietly accumulating shares, buying this dip. But then, on the other hand, you have a short-term indicator, the accumulation/distribution oscillator, and it's sharply negative. That's showing intense, aggressive selling right now. It's a classic tug of war.
And believe me, this isn't some quiet disagreement. This battle is happening out in the open with huge interest. The trading volume was almost 3 times its daily average. That tells you a ton of people are watching and making big bets on which side is going to win this fight.
So, with this epic battle raging between the buyers and the sellers, how does the story end? Well, let's map out the key battlegrounds, the price levels that we absolutely have to watch.
Okay, our investigation has zeroed in on 3 critical price levels. Think of these as the front lines. For the bears, the fortress they have to defend is that resistance up at 853. For the bulls, the line in the sand they cannot let break is the support down at 752. And smack in the middle, you've got this pivot point at 786, which could really decide the next big move.
So these levels basically give us our playbook for what could happen next. Scenario 1, the bullish case. If the bulls can punch through that 853 resistance, they could make a run for 950. Scenario 2, the bearish case. The price keeps falling toward that 786 pivot. Or maybe they just fight to a draw for a while and the stock goes sideways. But the real danger zone is scenario 4, a breakout down. If that 752 support level caves, well, that could open up a trapdoor to $7.
And so that leaves us right here with the central mystery of this whole story. You've got this incredibly strong short-term downtrend clashing with these subtle hints that long-term investors might be quietly buying in. So the big question is, which one of these powerful forces, which story, is going to win out in the end?